Hi, my name is Aziz, a fellow of the Association of Chartered Certified Accountants, ACCA. Welcome to part 8 of the course, Bookkeeping up to Final Accounts. Today, I'm going to talk about periods closed down and transfer of profit to reserve and interpretation or analysis of financial statements. Now, let me begin with the first item. When you close your accounting system down for a period, that is, you bring everything to a close at the end of a period, what actually happens to all the transactions in the nominal ledger? What happens to them? Now, I am going to demonstrate what happens when you do a period close on any accounting software. Don't forget that what I'm using here is a spreadsheet just to demonstrate to you what happens in a computerized environment. Now, this is what happens when you close your accounting system down at the end of every month or every year. The accounting system or accounting package that you are using uses the transaction balances in the revenue side of your chart of accounts or trial balance. I am going to show you now, okay, what I mean. Here is the transaction, the trial balance for the month of April that we just worked on. April is already behind us, and now we are not dealing with the month of May, but this is the month of April, and we have closed the system down. Now, so what happens is that when you do your close down and you go into, let's say you use Sage, you go into systems, select pre or close down, and so on and so forth. The system will work on what is on the profit and loss account or income statement side of your trial balance. Okay? Those items in the income statement or profit and loss account side are also known as revenue items because you enjoy the benefit of those items in one period and one period only. So to calculate your profit or loss for the period, the system will have to clear everything off. And what I mean by that is that the system will transfer the balances to reserve in order to calculate your profit or loss for the period ended. The profit or loss for the period ended will then be transferred to a reserve account on the balances side of the chart of accounts. Okay? Now, the items of the profit or loss or the income statement side of your trial balance actually start from sales. As you can see, look at the trial balance for the month of May. You are looking at sales, okay, right down to all the expenditure for the period. They are not balance sheet items, so they get cleared off to reserve. And what I mean by cleared off is I don't mean that all the transactions will be deleted. No, it is the balances on those accounts that will be moved around by the system. And this is what happens. I'm going to demonstrate that to you. What I've already done here, I've used a journal to do it, but in the computerized environment, the system will do it for you. Okay? Now, this is what happens. This is the journal that I've used. Okay? You can see that the sales item, the sales balance on the trial balance, because it's an income, it is supposed to be on the credit side. So the system, in carrying out the close down, will transfer all the items on the credit side to the debit side. Okay? Now, this is what I mean. Okay? Look at sales for the month of April. Because it's an income item, the balance is on the credit side, and this is in your nominal ledger. Every item here is linked to the nominal ledger and agrees with the nominal ledger. Okay? Now, the sales are credit item. The system will move them to the debit item when carrying out the close down. Okay? Like I've already shown you that this is the trial balance. Okay? All items on the credit side will be moved to the debit side. And the expenditure, all items of expenditure on the trial balance, which are on the debit side, okay, look at the debit side, which is the left side, okay, salaries, wages, purchases, staff training, and so on and so forth, will be moved to the credit side by the system. Okay, when carrying out the close down. Okay, now you send them, they will go to the credit side. Now, after moving stuff from credit to debit and from debit and so on and so forth, the balance between the two sides will be your profit for the period. Okay, which I have already demonstrated to you. As you can see, the profit for the period in the case of Joe Blocks Auto Services, profit for the month of April, which we have already reported, we are closing it down now, which is now going to the reserve. That's the difference between the credit and debit side, is what will go to the reserve. Okay, now look at the profit is 940.82, and that agrees with what was reported. Look at the extended trial balance here is 940.82, and look at the balance sheet. I've got the balance sheet for the month of April and May side by side. This is the reported profit for the month of, yeah, it's been rounded up. It's 941. Yes, it will be moved to reserve. Okay, now I am showing this to you so that you are aware of what happens, because when you go out there as an interim, okay, when you go out there as an interim and you are reviewing the nominal ledger as part of your reconciliation, you are likely to come across something in the nominal ledger, something like period end adjustment in each nominal ledger that has been nominal ledger code that has been affected by month-end close down activity. Okay, look at all the accounts that will be affected. The sales account or income item will be income account will be affected. Basic salaries and so on will be affected. So you are going through the nominal ledger, you are reviewing the nominal ledger because you are trying to reconcile, and you are coming across all the items. You know, as somebody who is trying to reconcile to find out what nominal, I mean, because you are looking at the nominal ledger, when I'm talking about reviewing it, you are looking at those accounts in order to decide whether those items should or should not be there. Okay, because you are trying to establish the legitimacy of every item in the nominal ledger. If you come across something like period end adjustment, you will not find any journal anywhere, because you may say, oh, let me investigate this. Where is the journal? No, you are not going to find any journal anywhere, because nobody has actually done any, processed any journal. This is a system generated journal. It will be generated by the system. You will not find it. Okay, so don't even bother to look for one. So as an interim, you know, the last thing you want to do is create an impression that you don't really know what you are doing by asking questions that you shouldn't ask, by asking questions about things that you should already know. So please watch out, because you are there as an interim to solve problems, not to be trained by anybody. So don't go asking questions that will embarrass you, create the impression that you haven't got a clue what you are doing. That will not really help. So it is very, very important. Now, reserve account, as you can see, that I've created here is 3501. Now, this is a very, very important code, okay? It's very, very, very important, because that is where the profit or loss is recorded after you close the system down. And it's also used for a lot of other adjustments. Now, the importance of the reserve account is demonstrated by the fact that at the system configuration stage, it is the first account that is set up. Okay? That has already been done for you in Sage, TAS, or other software that you can just buy. But for other ERP software, specially configured software like Sage and like Sun Account, SAP, and so on, the reserve account is the first code that is created before all the other accounts are created. I've seen that done before, and I'm sure that's how it's supposed to be done. Now, that takes me to the second topic, which is interpretation of final accounts. Okay, interpretation of financial statements. Now, why do people analyze financial statements? Why bother to analyze financial statements? And profit, talking about profit and loss account, balance sheet, notes to the accounts, cash flow, and so on and so forth. Why do people analyze them? Now, financial statements are analyzed for a number of reasons, among which are to determine your company's or business's eligibility for a bank loan. Now, if you want to go for a bank loan, your bank manager will want to know that your business, that the loan that will be given to your business, that is the investor's money, will be secure. Okay? So they want to know that your business will be in a position to pay back the loan. They want to know that your business is performing well. To do that, they will demand to see an up-to-date financial statement of your company and your cash flow forecast, so that they can perform the detailed analysis of the company's performance before coming to a decision about as to whether or not to lend you any money. You may also be talking to your bank manager about rescheduling your loan or your existing loan. Your bank manager says, can I see a set of accounts? When your bank manager gets your set of accounts, hopefully you have one to give them, they will do their own financial analysis and they will come to a conclusion as to whether or not they should give you the money based on the performance of your business as reflected in the financial statement. Now, financial analysis is also carried out for decision-making purposes. Okay, investment decision-making purposes. If your company is listed on a recognized stock exchange, such as London Stock Exchange, New York Stock Exchange, or NASDAQ, etc., investors want to analyze the performance of your company. And the performance will be reflected in the latest set of financial accounts. This is because they will want to be sure that your company has been doing very well and will continue to do very well, and that their investment will be safe. Individual investors may do it if they have the necessary know-how to analyze financial statements, but the analysis will mostly be carried out on behalf of investors by institutional investors, such as pension fund or insurance companies and so on and so forth. Those are institutional investors. Okay? Also, financial statements are awarded just to carry out, to decide whether for contract award purposes. Now, if you go for a contract, okay, if you want a publicly funded entity such as a local authority or central government department to give your company a contract, they will want to ensure that only financially stable entities are put in charge of publicly funded projects, because though the people in charge of the publicly funded entity are duty bound to ensure that the taxpayers' money is not exposed to unnecessary risk. The idea is to avoid losing taxpayers' money to a company that is already in danger of going bankrupt. So they will want to analyze your financial statements before they can decide whether or not your company should be given a contract, because there will come a time, if they do give you a contract, money will be paid to you like advance fee, and the last thing they want to see is for you to collect the advance fee and then go into administration the following morning and go down with taxpayers' money. They will not want that. So you, as an accountant in this area, you will be asked to analyze financial statements. Now, let me advise you. You need to be very careful as an accountant, especially if you are working in a publicly funded entity like local authority. You have to be very careful. Your boss will say, analyze financial statement, or people in your procurement will say, we need to analyze financial statement. But for your own sake, you must insist on seeing the financial statement that your analysis and report will be based on. Do not let anybody persuade you to rely on figures extracted from those statements, because those figures might be factually inaccurate, especially if they have been collected from the very same people or the same companies whose financial performance you are going to analyze. So insist on seeing the financial statement that you will analyze. Don't let anybody give you just numbers to analyze. Okay? Ideally, you should have copies of the financial statement that those entities have submitted to Companies House. See? That will give you peace of mind. Remember that your name will be on the report that your employer will base their decision on. So, if financially unstable entities are selected for a contract award, on the basis of the report that you have written, and those entities later go into administration soon after, taxpayers' money will be lost. So, who are administrators? Administrators are those who run financially distressed companies, mainly for the purpose of paying off all secured creditors. And your employer is not likely to be among the secured creditors. So, by the time money has been paid to secure creditors, there may not be any money left to pay your employer. And believe me, money will be lost. And of course, inquiries will take place, the matter will be investigated. And if it comes to light later on that your own financial analysis that was based on a set of non-existent or inaccurate financial statement was to blame for the loss of money, you will not be able to exonerate yourself by claiming that you merely followed your superior's instructions. That will not be good enough. And your financial reputation, your professional reputation and career will be on the firing line if you allow that to happen. Okay? Now, another reason people analyze financial statement is performance evaluation, which is what we are going to do today. Okay? Financial analysis enables us to see the direction a company is going in terms of asset management, financial stability, and performance. That is why it is also called trend analysis. So, to analyze the financial statement of Joe Blogs Auto Services Limited, our fictitious limited company, I am going to play the role of a business analyst. So, as a business analyst, one is supposed to support and guide management thinking. In this role, your relevance depends on the practicality of your advice. Therefore, it is essential that the analyst, is able to work collaboratively with service managers and operational teams in order to gain a proper understanding of their activities and make recommendations that address real-life business issues, not academic stuff. So, financial analysis can be broken down into 3 areas. There are 3 areas of financial analysis, okay? One is known as diagnosis, which doctors use. Diagnosis. It means looking at what has happened and why it has happened. The tools that accountants use for this task include ratio analysis, which I'm going to show you shortly, variance analysis, cost drivers, and so on. Okay? Cost drivers, cost classification, and so on. Now, another area of financial analysis, which is a very, very important area, is making recommendations. Okay? You have to make recommendations. As a financial analyst, your audience will probably ask, when you finish your analysis, this has not happened, that has not happened, etc. That needs da. The next thing the audience will say, okay, where do we go from here? Where do we go from here? Where do we go from here? So they want you to tell them what to do with what you have analyzed. Okay? You need to advise them how they can improve the situation that you have described in your analysis. Okay? And that means you have to identify business risks, you have to evaluate business risks, and you have to work with managers to eliminate or mitigate those risks. Okay? Now, here is another branch of financial analysis. You have to support managers. Okay? It's about support. It's also about supporting managers. Here, what I mean by that is you really have to roll up your sleeves and get involved. You need to get involved. Managers need to be able to convert your recommendations into concrete value-adding actions, and they will need your support. Okay? For instance, if you say working capital management is not good enough and it's a problem, you need to work collaboratively with the credit controller to bring the situation under control. Okay? What you do after constructing your analysis, after performing your analysis and explaining to management, etc., you need to build up what they call a tracker. A tracker. Now, I'm going to show you a tracker, what I mean by that. Okay? Now, here is a tracker. Yeah? A recommendation tracker. Okay? Several columns. You need to show date of report. I wrote the report on the 9th of June, and I will show you the report in a minute, in addition to explaining financial analysis. You also need to give it the name, financial performance analysis or trend analysis. Okay? You need to, you are the author of the report. Okay? Mr. XYZ, the author of the report. What is the nature of the risk that you have identified? Working capital management. Okay? That is the nature of the risk. Debt collection period is longer than creditors payment period. What is your recommendation? Now, before I go into this tracker thing, let me now show you ratio analysis and the recommendations that I have made. Okay? Okay? Now, ratios, there are different kinds of ratios that we use that are available to be, so to speak, but you have to be very selective. Don't just calculate ratios, okay? You have to calculate ratios that are relevant to the situation that you have come across in order to present a meaningful report to your audience, you see. Think about your audience. Okay, one of the ratios, I can just group it under working capital management. Is what they call current ratio. Current ratio means you divide your current assets. You know what current assets is. What current assets, I have already explained that. Current assets, you divide it by current liability. Okay? The total by current liability, and come up with a ratio. That is the relationship between current asset and current liability. This one demonstrates your liquidity, the liquidity of your organization. If your current asset has a relationship of 1-to-1, it means you have just enough money or just enough cash and other liquid assets, that is asset that you can sell off for money, to pay off your current liabilities. Okay, just enough. Ideally, it should be 1.5-to-1. That is, what you have is your asset, your liquid asset and cash is 1.1, 1.5 times size of your current liabilities. That is, debts that are due for immediate payment to suppliers, HMRC, and so on and so forth, which is very healthy. But if the relationship is the other way around, like your current liabilities being heavier than the current asset, then that will be bad news. It means you haven't got enough money in your bank account and you haven't got enough liquid assets to pay off your immediately due liabilities. Bad news. Then you need to do something. Your financial analyst, after looking at your situation, will advise you what to do. He or she should not just analyze and walk away. Okay? A second ratio, which comes under working capital management, is current assets, the ratio of current assets to current liabilities. That is current assets minus stock to current liabilities. Okay? What that means is this. What will your situation be, or the situation of your company be, if something happened and you are not able to sell what you have in your stock for cash straight away? What would the situation be? And you are just left with the cash in your bank account and other liquid investment. But your stock cannot be sold. But you have to pay off your creditors. And they are due for payment. Your payment to your creditors is due. But you only have the cash. You can't sell your stock. What would the situation be? It is also called quick ratio or acid test ratio. Okay? Another ratio that comes under working capital management, because those are the ones I'm going to use today, those are the ones that are relevant to our situation, is what they call debtor payment ratio. How quickly do you collect money from your debtors? Okay? You have to compare that with how quickly you pay your own creditors. If you collect money from your debtors a lot quicker than you pay your creditors, then that will be good news. But if it's the other way around, that will be bad news. Okay? Now, with those ratios, which are relevant to our situation, I am now going to show you the analysis of our company here, Joe Blocks. Now, here is an extract. What I've shown you is an extract from the financial statement. I have extracted the turnover. Ratio analysis, let me just repeat, is a comparison of performance from one period to another. the comparison of a company's performance from one period to another, or even within one period. But ideally, it should be from one period to another so that you will know whether things are getting worse or getting better. Okay? Now, here is an extract. This I have extracted from the financial statement. Like I said earlier on, if in the course of your duty, somebody gives you just this extract, you have not seen the financial statement, you should not feel comfortable until you have been given the financial statement. Okay? And the financial statements are here. You see? And ideally, this financial statement should have been submitted to Companies House. And if they've not been submitted to Companies House, if they are financial statements that have just been prepared by the organization, then it should be signed and rubber stamped by the board of directors or whoever happens to be the signatory for the company. Don't accept an unsigned financial statement. Do not accept extra from the financial statement from anybody because they could be factually inaccurate. Insist on seeing the financial statement. All the numbers I've shown you on the extract, you can actually see them here on the financial statement. Okay? Turnover in the month of April, £51,590. Okay? In the month of May, it has gone down to £6,310. And I will explain why now in my ratio analysis. Okay? Here we go. Now, in the ratio analysis, this is where the input is. These are the extract that I'm using. Okay? The extract from the financial statement. Every figure you see here is traceable to the financial statement. And the figure on the financial statement is traceable to the extended trial balance. And every number, every balance on the extended trial balance or trial balance is traceable to the nominal ledger. The figure, your report must have a very solid root. Don't just put stuff on paper. People should be able to trace every figure to your underlying accounting records. Like I said earlier on, it is extremely important that your financial statements are in agreement with the underlying accounting records. Otherwise, you'll be wasting your time. And you'll be churning out reports that have no basis. And if people base their decision on your report, which is not very viable, then if anything goes wrong, the fault will be yours. Okay? So, here is the analysis itself. Sales has not grown between the month of April and May. It has actually fallen significantly. That I will explain in the report. Okay? Now, the gross profit margin was 69% in April and it fell to 53% in May. The net profit margin, operating profit margin was 19% in May positive, but it significantly fell to 173% negative in May. Okay? Now you have current ratio of, that is current asset divided by current liability. In the month of May, it was not good because the company was indebted. It had more debt than its available assets and liquid assets. Available cash and liquid assets. But the situation got even worse in May. Asset ratio, for both months are even worse. Okay? Now, look at debtors ratio. Debtors payment ratio. Debt collection ratio. In April, on average, the debt collection period that it took each customer 35 days to pay his debt. On average. Okay? In May, it fell to 17 days to collect money from debtors, which is good. But again, if you look at creditors' payment, in April, it was 17 days. It took on average 17 days to collect money from credit and to pay creditors. So it fell to 2 days in May. Okay? Now, the conclusion one can reach here is that the company has paid money a lot sooner than it collects money, than it has collected money from its own customers. That is bad news. And that is partly responsible for the current ratio being so poor. Because if you are not collecting enough, if you are collecting money from your customer slower, a lot slower than you pay money to your creditors. You pay your creditors a lot quicker, but you are taking your time. You are not actually collecting money a lot very, very quickly from your own customers. Then, of course, the result will be cash flow problems, which is what this company is experiencing. I am now going to bring up the report itself Look at the report that I've written here. Okay. Okay. Full screen. Now, your report, you have to address your audience properly. Here is a report which I've written by way of a memorandum to the board of directors from the accountant. Subject: financial performance trend analysis, April and May. Date of the report. Now, this is my format. I love this format. I like this format. I don't know about you. Maybe you can come up with something different in the course of your duty. Fine, no problem. But I love this one. I like it. That's what I use. Now, first of all, the terms of reference. That is what the report is all about. Terms of reference. This report seeks to explain the trend in the financial performance of Joe Block Auto Services Limited between April and May 2020. Sorry. Readers are advised to refer to Appendices 1, that's ratio analysis, and Appendix 2, financial statements, which I've just shown you earlier in May 2020, which support this report. Okay? Straight away, you tell them that here is a report, but if you want to see all the detailed calculations, go and look at the analysis, which I showed you earlier on. Call that Appendix 1. Okay? And then the financial statements themselves, which I've referred to as Appendix 2. Financial statement of May and April together. I put them together because you have to do that. When you prepare your financial account, unless the period you are dealing with is your first period, you have to make sure that you show the figure for the comparative period. Okay? As you can see, look at the profit and loss account. The figures for April, yeah, they are all here. The figures for May are all here, so that your readers can look at how things have been moving. It is extremely important that you do that. Okay? Let me go back to my report. Okay, here is the report again. Now, when you move away from the terms of reference, you also have to show the caveat. Okay, a warning sign, a caveat. Now, this report, you have to warn your readers of the report. This report is based on a purely historical information. The financial statement that forms the basis of this report only look back into the past. The figures were prepared, they've done, but things have happened since the financial statements were prepared. Okay? The cash balance that you show on the financial statement are not going to be the same because we are now reporting on the 9th of June and you prepare your report up to the end of May. So the cash balances may have moved. The assets shown in the accounts may have been sold. This is extremely important that you explain this. Extremely important. So events may have occurred after the reporting date of 31st of May 2020, which may render the analysis and opinion expressed in this report completely obsolete. Okay? Things may have happened since then. You have to let everybody know. Therefore, attention should be paid to most recent developments that are relevant to the organization. If I say that if I say in my report that the organization has not done very well, and things have since improved since the date of this report, then people need to know. Okay? They may have improved their debt collection, or the company may have even gone bust. But the report will not cover that because it's only focused on what happened in the past. Okay? You have to let your readers know. Now, after the caveat, then you make your recommendation, because as an analyst, you are not supposed to walk away after analyzing. You are supposed to recommend what should we do to make the situation that you have described better. As explained below, I've not even looked at the causes of whatever happened. Okay, our working capital management needs to be improved. Paying our suppliers a lot sooner than we collect from our customers could lead to a cash flow shortage if the practice is allowed to continue. Okay, you also have to explain to them the impact of COVID-19 outbreak on the company performance should be mitigated by taking advantage of available government support for businesses. Joining the government job retention scheme will result in an inflow of cash to fund salary payment while our staff are furloughed. Okay? Then you go on from there and then say, as a small company, Joe Block Auto Services Limited is also entitled to business rate relief. Therefore, we should explore the possibility of obtaining this relief from our local authorities, including even arrears. Okay? because the company started in April 2020. It has paid business rate, which may not have been, we probably should not have been paid. So go to your local authority, exercise your right, obtain business rate relief, and save your cash. Then after that, after making your recommendation, you start talking about the performance. From April 2020 to May 2020, the company's performance, that is turnover, sales, that is, fell from 31,590 to 6,330. This represents an 80% decline, which is attributable to the global lockdown caused by COVID-19 outbreak. I've already explained that. I've shown you the analysis. The impact of this has been echoed in other key areas, such as gross profit percentage, which I showed you earlier on. This ratio refers to profit as a percentage of sales. It reflects our ability to control our direct cost, what they call cost of sales. Okay? Cost of sales. Now, if I show you what I mean by cost of sales, these are my cost of sales in the financial statement. Okay? Now, in the notes of cost of sales, opening stock. Okay? Cost of sales, opening stock, purchases, closing stock, and the cost of sales is 69.20 in May, but 97.67 in April. It fell between those 2 months. But that does not mean that we have been able to control costs there. It's because there has been no business at all due to COVID-19 outbreak. Okay? There has been no business at all. So that's why the cost of sale is so low. But if you look at it, so the decline in the gross profit percentage is not down, it's actually down to the effect of COVID-19. Okay? Now, the net profit percentage, this represents operating profit before tax as a percentage of sales. While operating costs actually fell from 20,822 pounds in April to 14,000 in May, net profit percentage actually fell from a positive 19% in April to negative 173% in May. Now, operating costs, you will expect the decline in operating costs to actually result in a higher profit. But that has not happened between April and May, because the company is saddled with certain costs. They are called fixed costs. Okay? That is those costs that cannot be avoided, even if we don't generate any income at all. This is due principally to payment of staff salaries in both months, despite a significant reduction in sales income as a result of COVID-19 induced lockdown. Salaries form part of the company's fixed costs, as they do not vary at all with sales income. Okay, you also have another fixed cost, such as interest payment on loan on the finance or the loan. Interest payment on loan. That is what shall I call it? The loan that was obtained to build the lease. Yeah, the lease. Interest payment on lease payment. That is fixed. Interest on lease is fixed. It has to be paid. Okay, that is fixed. Now, if I move on to working capital management. Now, working capital management means controlling your debtors. Okay? Controlling your debtors. And when you control your debtors, it means you get paid on time for your services, for goods or services that you have sold. Now, on average, like I explained earlier on Appendix 1, invoices issued to customers remain unpaid for 35 days, but this fell to 17 days in May. This means that we managed to get our customers to settle their bills a lot quicker than we did in April. Now, working capital management also means controlling your creditors. Paying your creditors within your agreed period in order to take advantage of available payment discount and remain on good terms with them. Okay? In April, the company pays suppliers within 17 days of receiving their invoices. In May, average invoice payment period fell to 2 days. Now, debt collection period and creditor payment days are a measure of working capital management. In both periods, our performance could have been better. We paid our suppliers a lot quicker than it took us to collect from our customers. The result is the low current ratio reported above, which has impacted our cash flow. You see? Now, let me now move on to liquidity, which is also tied to working capital management. Now, liquidity refers to availability of cash and other assets that are convertible to cash at short notice for the purposes of settling your immediate financial obligations, that is paying suppliers and other little bills. Now, there are two key ratios that are used for liquidity measurement. Current ratio, which I've already explained. This compares available cash and other liquid assets to financial obligations that are immediately due for settlement. And what I mean by liquid assets are assets that can be converted into cash very quickly. Okay, such as short-term investments and deposit account balances. Ideally, the ratio should be 2-to-1, which means available cash and other liquid assets in total is twice the size of our immediate debts. Okay? Anything less than 1-to-1 is considered unsafe. It's not safe. In April, the ratio was less than 1-to-1. It was actually 1-to-0.85. Okay? It declined to even 0.59 in May. This is partly due to our inefficient working capital management, which I've already explained. Now, the acid test ratio. This indicates that our cash situation would be if we could not sell our stock. Okay? Our score fell from 0.74 in April to 0.54 in May, which implies that if our stock items could not be converted to cash through sales, we will be seriously short of cash. So, according to the attached, you say that to the management, okay, in your report. According to the attached financial statement, the company moved from a positive net worth of £1,141 in profit. Yeah, and what I mean by net worth is this. Okay, let me just show you the net worth. Yeah, this is what I mean by net worth. Your net worth is all your assets added together minus all what you owe other people. What is left is your net worth. Look at the company's net worth in May. In April, it was just £1,141. Okay? After the asset minus all the debts that are owed to the company, or that the company owes other people. Now in May, the situation got even worse. Okay? Instead of actually having a positive net worth, it actually went into negative net worth. That means we owe more. What we owe other people, our obligations and everything, is in total is higher than our assets. Bad news. Now, and what is responsible for that? You have this finance lease obligation. Okay? Obligation under finance lease, which must be paid. That obligation must be fulfilled. We must pay the council because we lease the premises from the council. You also have other creditors that are due within 1 year, and the loan from the director, which is also due within 1 year. I mean, the director, not all of the loan is due within 1 year. The director is quite laid back with regard to collection of his own money. Now, he has decided to waive interest on the loan. But overall, the company, in terms of performance, has not done very well due to the impact of COVID-19. Look at the size of the loss in the month of May. You see, in the month of May, sale is very little, £6,310 only, whereas all expenses together has produced a loss of close to £11,000. Simply because, if I show you the notes to the accounts, as you can see, operating expenses, you see these two items, okay? basic salaries has remained unchanged between the 2 months, despite there not been any sale at all. Okay? Now, those two items need to be taken care of. I have already explained that the company should go for any help it can get from the state. Now, and then you go further here, that the company has been kept alive by a personal loan from the director. Repayment of the director's loan is subject to availability of cash after operating expenses have been taken care of. Besides, the director has decided not to charge any interest on the loan. So this is a company that is actually kept alive by the director. And things have been particularly bad because of the impact of COVID-19. You then have to end your report by saying that, look, it should be borne in mind that the company started with a lot of pre-incorporated costs or pre-incorporation costs. Costs that were incurred before the company started trading. The company started with a lot of pre-trading costs that were charged to the month of April alone. Also, COVID-19 disrupted business activities in both months, in both April and May. As a result of that, we can safely conclude that the company has not experienced any form of stability since it started trading in April, due to events that are beyond the control of the management. I'll be very happy to discuss this further at the next management meeting if required. Kind regards, accountant. Okay, you end your report like that. Now, like I said before, don't just analyze and walk away. Okay, it's very, very important. Don't just analyze and walk away. You have to support your management. You have to support the operational team. Do not be a consultant. Okay, act in a consultative manner. Don't be a consultant. Now, a consultant is somebody who just makes recommendations, makes analysis, and walks away and leave other people to carry out his recommendations. And those recommendations may or may not work. But you, if you act in a consultative manner as a genuine business analyst or a financial analyst, you have to get involved. You have to be a part of the team. Okay? Work with them to fix problems. Now, and how can you do that? You have to be in constant touch with the management team and the operational team. Now, I have set up this tracker. This is what you should do as an analyst. Okay, you've written your report, but the management also has to respond to you about how the problem will be fixed. For instance, I have said here, I said in the report that working capital management, debt collection period is longer than creditors payment period. Okay, what is your recommendation here? We need to ensure that customers remain within their credit limits and settle their invoices within the payment period. At the same time, we should take advantage of payment discount offered by our suppliers by settling their invoices within the agreed payment period. Also, we should not pay suppliers before we are paid by our own customers. Okay? And then the management has to respond to you. They can't just leave. It's not going to be a one-way communication, okay? It shouldn't be that way. The management will then say, okay, customers are billed as soon as their vehicles have been serviced, and the bills are sent out immediately after being issued. Late payers will be contacted by phone or sent reminder notices. Account statement will be sent to customers as a way of reminding them of their obligation. That is management's response. You also have to find out who is going to carry out this task, who is responsible for this area. The responsible person in this case is the bookkeeper, okay, Mrs. Linda Blocks. And the date, they have to give you a date about when this recommendation will be implemented by them. They have to give you a date. Now, we have been assured that this recommendation, that is sending statement of accounts to suppliers on time, will be implemented on the 15th of June 2020, which is 1 week from the date of the report. On that date, you should contact the credit controller, whoever is responsible for this part, to say, look, how far are we going? Where are we going? How far? How can we help? Has anything changed? When they respond to you, their response will also be, you have to record it on this tracker, on your tracker, what they call recommendation tracker, okay? Report your recommendation, because there will come a time, if things don't work well in the company, they will say, what did we do about it? Then they will call you as an accountant or as an analyst, have you done anything to assist? Then you bring up this tracker. Or ideally, don't wait until you are called. Arrange to meet with the management regularly and present this tracker to them. Okay? The responses, your recommendation, their responses, and the date that everybody promised to do their part, and what has happened is then. Now, here is another one. Now, you have also identified a business risk, which is the impact of COVID-19 outbreak on the business. Your recommendation is this. We should check the company's eligibility for government support for the self-employed. Because as you can, since COVID-19 started, government has been assisting people. This is known as SAIS, Self-Employed Income Support Scheme. Okay? This was introduced in March this year, and billions of pounds have been paid out. The scheme has been extended till October 2020. Let your company know that. Ask them to take advantage of that. Now, what has the management got to say about it? Mr. Joe Block, the director himself, says he is working on the matter and will report back in due course. Who is responsible? The director himself will take care of the matter. When will he actually do something? That will be on the 20th of June 2020. And come that date, please drop him an email or go to him to have a quiet meeting. Okay? Now, here is another recommendation. Okay? You have spotted problem with the company's solvency. That is, the company not having enough cash. Okay? To pay creditors. The company recorded net current liabilities in both months, which I've just shown you, that is more debt than asset, which implies that the amount that are due for payment very soon to suppliers and other creditors in total is more than the total available cash and other liquid assets. So what is your recommendation here? Customers should be encouraged to pay their invoices sooner while we take full advantage of the credit period given to us by our suppliers. At the same time, dividend payments should be deferred for as long as possible. So, what is the response of the management to this one? The directors have agreed to waive their right to dividend payment till the company is financially strong enough to pay. Okay? Also, Mrs. Linda Block has promised to send statement of account to all customers with balances on their accounts. Who is responsible? The director himself and his wife. They will take care of this matter. And when will they do it? On the 15th of June. If they don't do it, please, okay, go to them, have a gentle meeting with them. And from time to time, try to have a management meeting where this tracker will be presented as a way of, letting them know that you are with them every inch of the way. You are not a consultant. You are working consultatively. You are an analyst. You are working collaboratively for the good of the company. So that brings me to the end of the video. Now, please do like, share, and subscribe. And thank you very much for listening and watching. Take care, and I see you in my next video. I've got other videos coming up on a range of other topics. If you subscribe, you will automatically receive my video. Do take care, and thank you very much. Bye-bye.